Imagine turning $50 into a life-changing portfolio. Sounds like a fever dream your cousin pitched at Thanksgiving, right? Well, buckle up. Because today we're talking about how ordinary people are actually doing it, step by deliberate step, without gambling their rent money on a coin named after a dog. The crypto market has minted millionaires and vaporized savings in the same calendar year. And the difference between those two outcomes almost always comes down to one thing: structure. We're not talking about luck, insider tips, or finding the next 100x gem. We're talking about building a real, scalable position, the same way serious investors build anything worth keeping. Here's the uncomfortable truth most influencers won't tell you. The people who scaled small positions into meaningful portfolios didn't do it by being bold. They did it by being boring on purpose. Dollar cost averaging, the practice of buying fixed amounts on a fixed schedule regardless of price, is so unsexy it's practically criminal. And yet, it has quietly outperformed panic buying and FOMO trading for the vast majority of retail investors over the last decade. Think of your first crypto purchase, like planting a single seed in soil you don't fully trust yet. You don't dump the whole watering can on day one. You start small. You observe the environment. You learn how the asset breathes before you commit the rest of the garden. The psychological trap most beginners fall into is conflating excitement with strategy, buying aggressively when prices spike and freezing, or worse, selling when they drop. History shows us that Bitcoin, for example, fell over 80% from its peak in 2017 to 2018, and then went on to set all-time highs just a few years later, rewarding the people who held a process, not just a position. Here's what the doom crowd gets wrong. Volatility is not the same as failure, and a red portfolio is not a broken one. Every major asset class in history, equities, real estate, commodities, has gone through brutal drawdown cycles, and crypto is simply a younger, louder, more dramatic version of that same timeless story. So what does scaling actually look like in practice? You start with a base allocation you could afford to lose entirely, maybe 1 to 5% of your investable assets, and you treat that as your tuition, not your ticket to early retirement. From there, you scale into strength, meaning you add to positions when your thesis is confirmed by on-chain data, adoption metrics, or macro conditions, not because a tweet made your heart race. Position sizing is the unsung hero of portfolio building. The difference between a 10% loss that stings and a 10% loss that ruins you is entirely about how much of your capital was at risk. Diversification within crypto matters too. And we don't mean holding 40 different altcoins hoping one moons. We mean thoughtfully splitting exposure between high conviction blue chips like Bitcoin and Ethereum and a smaller, higher risk satellite position in emerging projects. This structure lets you participate in upside without betting the whole farm on a protocol that might not exist in 3 years. One of the most overlooked levers in scaling a small position is reinvestment discipline, taking partial profits during euphoric rallies and redeploying them during fear-driven corrections, which sounds obvious until your emotions convince you that this time the number only goes up. The investors who compounded small accounts into serious wealth weren't smarter than you. They were just more committed to the process when the process felt pointless. Let's address the elephant in the room. Yes, you missed the early Bitcoin prices. Yes, you missed the 2020 bull run. And no, that does not mean the opportunity is gone. Every cycle introduces a new wave of infrastructure, new use cases, and new entry points. The asset class is young enough that disciplined latecomers have still built meaningful wealth. The real secret, if there is one, is that scaling in crypto is less about crypto and more about mastering the timeless skills of risk management, emotional regulation, and long-term thinking. Discipline compounds just like capital does, and every good decision you make reinforces the habit of making another one. So here's your philosophical homework. Decide in advance what you'll do if your position drops 60%, because it might, and the investor who has a written plan in that moment will almost always outperform the one who improvises. Comfort with uncertainty isn't recklessness. It's the foundation of rational, sustainable participation in any volatile market. Start small, stay consistent, size responsibly, and let time and process do the heavy lifting that most people mistakenly assign to prediction and timing. The portfolio you build this way won't make you rich overnight, but it might actually make you rich, and that distinction is worth everything. And if you're ready to put that same disciplined, structured thinking to work beyond crypto in real estate investing, home contracting, or connecting with the right lenders, check out our links in the description below because we can help you get started.